Did you see this video last week?
The smallest home on the market in more than 10 years is up for sale in Cupertino. It's about the size of an average American hotel room, but it's listed for $1.7 million.
Wow, $1.7 million for a tiny house. No wonder people in the Bay Area thinks buying a home is out of reach. Join me as I share with you how much income you need to buy a house like this in the Bay Area. Okay, maybe not exactly this one. Let's just focus on the reality of affording a medium-price home here in the Bay Area. By the way, the median home price last year in Cupertino, where this house is located, was $3,012,500. What I will share with you is a general framework where you can work it easily. After watching this video, you should be able to decide for yourself if you are ready or not to take the next steps to become a Bay Area homeowner. This is just a starting point. Let me lay some ground rules or framework for this video. Everyone that's watching this video is going to be in a very different financial situation and different levels of risk tolerance. So I'm not going to tell you how much you should spend, how much you should budget, how much you need, etc., etc. Let's start with this. There are several guidelines on determining how much house you can afford. By the way, just to be clear, I'm not saying these are wrong or these are the right things to follow. I'm merely sharing with you what they are and my experiences as it relates to these guidelines. All these guidelines have some deviations, but the gist is basically the allocation of your gross monthly income. Gross monthly income is used because for the following reasons. You get consistency because it provides a consistent and easily verifiable measure across different borrowers. It includes all income before deductions, such as taxes and other withholdings, ensuring a standardized approach to assessing a borrower's ability to repay. Basically, if we were to use net income, everyone's deductions are different and it brings in different variables and you can't truly see the real picture of what someone can afford. Many mortgage lenders and underwriting guidelines use gross income to calculate DTI ratios, making it consistent with industry standards and facilitating comparisons among borrowers. Gross income makes for simple calculation. It is typically easy to calculate and is readily available on pay stubs or tax returns, simplifying the calculation process for lenders and borrowers alike. Okay, let's talk about the rules or guidelines that you can work with. The first one is the so-called 30-33 rule. This general guideline suggests allocating 30% of your monthly income to housing costs. The second 30% suggests that you need to have at least a 20% down payment to avoid PMI. PMI is private mortgage insurance. You have PMI if you are coming in with less than 20% down payment, and plus another 10% as a buffer or a safety net. That's your second 30%. In the third part, the 3 suggests that you shouldn't be spending no more than 3% of your annual salary on the price of the home. Now, I don't know if you think this is conservative or not, but in the industry, this is considered conservative, prudent, and very safe way of determining if you are ready to buy. By the way, Dave Ramsey actually suggests only 25% of your gross monthly income, and get this, with a 15-year mortgage, not a 30-year, 15 years.
If your payment is much more than a fourth of your take-home pay, it doesn't leave much wiggle room in your budget to do other things.
Exactly. The 25% is based on having done budgets for 30 years with people, and I'm saying where you are now is your projected income today, even with the house prices so high, to get a 15-year fixed rate where the payment is no more than a fourth of your take-home pay. Now,
okay, so if you follow this 30-33 rule for this $1.7 million property, this is how it's going to look like. Let's calculate it backwards since we know the purchase price. Purchase price divided by 3 is $566,666. Next is our 20% plus 10%, and that equals to 20% is equal to $340,000. That represents your down payment. 10% is $170,000. That represents your 10% buffer or safety net. Finally, 30% of your monthly income should be allocated to your monthly mortgage. To get that, we divide $566,666, your annual salary, by 12. That gives you around $47,000. 30% of that is around $14,000. So here are the final numbers. 30% max monthly mortgage payment, $14,166. 30% down payment and buffer, $510,000. 3 times your salary, $1.7 million. Anyway, moving on. The second one is called 28-36 rule. These numbers basically corresponds to the front and back end ratios of your DTI. These are mortgage terms. DTI stands for debt to income ratio. It's a metric used by lenders to assess your ability to manage monthly payments and repay debts. DTI is calculated by dividing your monthly debt payments by your gross monthly income. The front-end ratio of 28% is the maximum percentage of gross monthly income you should spend on housing. We are talking about your mortgage payments here, the PITI, meaning principal, interest, taxes, and insurance. So whenever you hear front-end ratio, just remember that all that's being talked about here is purely mortgage payments and nothing else. The back-end ratio is at 36%. This is the maximum percentage of gross monthly income you should spend on all your debts, including housing. There are no rules or guidelines of how much down payment or how much reserves or how much house you should buy with your corresponding yearly salary. It's pretty open. They just calculate your DTI and they figure out if there are houses you can afford in your market, taking into account your down payment, reserves, and other debts. So there's no hard and fast rule of 3x your salary and that's the maximum that you should buy. If you fall within this guideline, chances are you can get approved for a mortgage, as this is what most lenders think makes for a safe borrower. This tells the bank that you can very much pay down all your obligations and you will be a safe bet for them. Again, they also take into account if you meet all the other requirements that they have. The third guideline is one that, in my experience, most banks here in the Bay Area use. It's basically similar to the 28-36 rule, only the ratios are higher. Instead of 28-36, it's 45-49. 45% allocated to your monthly mortgage payment alone and 49% for all total debts. Yes, if you're thinking this is the most aggressive, it is. The reality is that there are actually other loan programs out there that can even go to 50 and even 55 DTI. Word of caution for you guys, these are just the starting points. There are so many other requirements and guidelines that a lender looks at. These numbers, whether you follow the 30-33 or any of the other, is meant to give you a springboard, if you will, if you are ready to dive into home ownership. Hey, by the way, I have a free home buyer's guide that you will find helpful. Link in the description. Let's look at how this plays out by the numbers. Now, I'm in the San Francisco Bay Area, so I'm going to use examples here, but you can easily follow along with your own numbers. According to Google, the annual salary of a top earner in Silicon Valley is around $143,000. Let's just call it 150 for ease of calculation. So if we apply the 30-33 rule, this means 30% monthly mortgage would look like this. 150,000 divided by 12 equals 12,500. 12,500 times 30% equals 3,750. This is the one that goes towards your monthly mortgage. This is the all-in number for mortgage. If there's HOA, you include HOA on here as well. For the next 30%, that's for down payment and reserves. We can't come up with that yet, so we have to go to the third part, which is 3x your salary. 3x your salary to purchase a house, which translates to 150,000 times 3 is 450,000. So now we can get the 30% of 450,000, which is 135,000. Okay, so let's look at those numbers again. 30% monthly is 3,750. 30% down payment and reserves equals 135,000. 3x is 450,000. Okay, I could have told you right off the bat when I calculated that 30% monthly mortgage of 3,750, that wasn't going to work. I know what the numbers are, and an all-in monthly mortgage of $3,750 is just too low if you are looking for a single-family detached home. There are no single-family detached homes in San Jose, California for $450,000. You can buy a condo or a townhome up to $450,000 as long as the HOA is below $600 per month to meet this 30-33 rule. The other two guidelines, it's simply getting 28% and 45% of your gross monthly income to come up with the maximum monthly mortgage payment. In this case, 28% of $12,500 is $3,500 and 45% of $12,500 is $5,625. Obviously, I can't calculate your back-end DTI because I do not have access to your debts. For you to calculate it, you need to know what your minimum monthly payments are for all your debts. Cars, credit cards, student loans, and any other installments. You can run your credit to see what you have outstanding. So as you can see, when you have a higher DTI ratio, you can afford more house. The flip side of that is that you are basically maximizing your debt level. So let me show you how much you actually need to be able to buy a medium price house in San Jose, California. The median is 1.3 million as of the end of January 2024. Let's start with the 30-33 rule. Let's go in reverse. 1.3 divided by 3 would give us a salary of around $433,000 a year. 30% of 1.3 is 390,000. The other 30% equals 10,824. So how realistic is this? Well, if you look at my handy dandy Google mortgage calculator, this can actually work. And I can also tell you that there are really houses out there in San Jose, California that are at 1.3 million and below. And with this scenario, you are still below the 30% that equals to 10,824. If you really wanted to bump into your 30% max mortgage payment, you can bump up your purchase price all the way to 1.6 million. But that would also mean upping your down payment and that 10% cushion from 390,000 to 495,000. However, you are now beyond the 3x your yearly income. But what if you wanted to push your luck, so to speak, and go all the way up to the 45% DTI? That would mean you are allowed to have your monthly mortgage payment up to $16,000 plus monthly. With a 45% DTI, your budget goes all the way up to 2.5 million. And if you still wanted to follow the 30-33 rule and have a 20% down payment plus 10% buffer, you need to have 750,000 total. Now, I have to tell you that I do have first-hand experience with this. Years ago, I had 3 separate clients that were all pretty much in the same financial situation. All got approved by a lender for around $1.2 million. The first client told me flat out they weren't going to look for homes up to their maximum approval. He only wanted to look for houses up to $700,000. I asked him why, and he told me that while he can pay the mortgage on a $1.2 million property, he wasn't comfortable seeing that big mortgage number. Second buyers, on the other hand, were pushing the envelope. Not only were they maximizing their loan approval, but in fact, they were pushing to get approved for a higher amount. I can't remember all the circumstances, but I believe they got approved for an additional $200,000. Most likely, they paid off some debts and other financial massaging to get that approval higher. The third buyer also was pushing the envelope because he wanted to buy in an area that was more expensive than what his approval was for. Again, I don't remember the exact circumstances, but the end result was that we got him approved for a higher amount as well. All these 3 clients ended up getting the houses that they wanted and at the price point that they chose. And here's what I saw, what was happening to their lives for the past 10 years. Client number 1, the one that didn't go for the maximum amount, I've seen him and his family making regular vacations and buying several luxury cars throughout the years. By all accounts, from what I have seen and have heard from people around them, they have been pretty happy with their situation. If I can use one word to describe them, it's that they're relaxed. The house that they bought, by the way, when compared to my other 2 clients that went for the maximum, wasn't in a bad city, but certainly not one that I would consider the best to buy at his financial capability. The other 2 bought in one of the most sought-after city in the East Bay in a much more affluent city. That's why there's that over 50% price difference. Anyway, continuing on, the second clients, what I have seen and heard through the years, especially when the pandemic hit, they experienced hardship and they actually ended up selling their house, and sadly, it was even for us a slight loss. The third client that also pushed his budget is actually thriving. He's made several upgrades and by all accounts have done very well for himself. So what's the takeaway from this story? As you can see, client number 1, the conservative one, it really worked out and continues to work out for them. By all accounts, they are pretty happy with their decision and they are thriving. The second set of clients didn't end good. They ended up losing their house and was forced to sell. It wasn't a foreclosure or anything like that, but the point is that selling the house wasn't on their terms. They were essentially forced to do it. The third one, which is also the other aggressive client, is doing pretty well. By all accounts, him pushing the limits of what he can afford worked out for him. He's not in any distress or have experienced any financial distress because of going with the higher or more aggressive approach with the purchase of his home. As you can see from this, you are really the only one that can tell what will be comfortable for you. You need to look at these general framework or guidelines and apply it to yourself, and you need to be honest with yourself. For me, I like the conservative approach. For my stress level and sanity, it's much better. Now, if you know yourself very well and have always been one to push the limit, why not? Just make sure that you are not biting too much. Hey, thanks for watching. Check out my next videos for more first-time homebuyer tips.